Hello everyone, it's Friday, February 27. Today we'll analyze the euro and British pound charts to assess potential market moves. Yesterday both the euro and the British pound came under pressure, while the US dollar gained ground. Demand for the greenback was supported by encouraging data on initial jobless claims, which rose by just 212,000, well below the expected 215,000. These figures continue to support the view that the Federal Reserve's interest rate cuts at the end of the last year have helped stabilize the labor market. On Thursday, the market focused on the ongoing issue of Donald Trump's trade tariffs, particularly regarding China. The Chinese government expressed dissatisfaction with the latest tariff threats, while the Trump administration announced plans to initiate an investigation following the Supreme Court ruling that struck down some previous tariffs. As a reminder, Trump has already imposed a global 10% tariff rate, with plans to raise it to 15%. If this occurs, China is likely to retaliate by limiting exports of rare earth minerals, further clouding the market outlook. Despite these developments, the market remains in a state of equilibrium for now, though uncertainty about Trump's next move continues to linger. Turning to today's macroeconomic calendar, we have a busy schedule with several key reports. This includes France's fourth quarter GDP growth data, consumer prices from both France and Germany, and German unemployment figures. Germany's inflation is expected to come in at 0.5% month-on-month and 2% year-on-year, aligning with the European Central Bank's target. The number of unemployed persons in Germany is forecast to rise by 3,000 in January, with the unemployment rate holding steady at 6.3%, unchanged from December 2025. Later in the day, attention will shift to U.S. producer price data for January. Inflationary pressures have been evident since October, with the producer price index increasing by 0.1% in October, 0.2% in November, and 0.5% in December. The January reading is expected to show a 0.3% increase, with the annual index projected at 2.6%, down from 3% in December. Core producer prices are forecast to decline to 3% year-on-year. If the data comes in stronger than expected, the dollar could face downward pressure. This is because any sign of inflation easing, as the Fed hopes, would increase the likelihood of further rate cuts sooner than anticipated. Now let's move on to technical analysis. The 1-hour EUR USD chart suggests that selling could be a viable option at 18.28, the upper boundary of the current sideways range. A rise followed by a false breakout at this level would trigger a sell signal, pushing the euro down to 18.02, the midpoint of the range. If the price breaks and holds below 18.02, it could target 1.1777, with the potential to extend further down to 17.45. At this level, I would recommend considering long positions on a rebound, aiming for an intraday correction of 25-30 pips. Long entries at 18.02 could be placed on a false breakout, especially if supported by positive data, with the target at 18.28. If the price breaks above 18.28, expect strong upside momentum, potentially taking the euro to 18.57 and possibly extending to 1.1883. At this mark, I would advise going short on a rebound, targeting a 20-25 pip pullback. Short positions at 18.57 and 18.28 should only be considered following a false breakout. Regarding the British pound, long positions could be considered at 34.63. With today's UK economic calendar light on data, traders will focus on the speech by Bank of England chief economist Hugh Peel. If he signals potential rate cuts sooner than expected, the pound could face increased pressure. A false breakout at 34.99 would trigger a sell signal, pushing the price down to 34.63. If Bill adopts a softer tone, a breakout below this level could open the path to 34.32, potentially reaching a 1-month low around 34.09. At this level, a long positions on a rebound would be invisible, targeting a 20-25 pip move. However, since today marks the last trading day of February, hitting a fresh low seems unlikely. Most likely, price action will remain range-bound. Long entries at 34.63 and 34.32 should be considered on the false breakout. Alternatively, if the price rises above 34.99 amid subdued selling, sterling could advance to 35.24 and 35.51. At this mark, I could recommend going short on the rebound, targeting a 25-20 pip move. Long positions at 34.99 and 35.24 should only be considered after a false breakout. Good luck and enjoy your weekend.